When it comes to specially designed whole life insurance policies designed for cash accumulation, you'll hear us talk about the cash value as well as the death benefit. A question that I'll often get is, at the death of the insured, is both the death benefit and that cash value paid out to the named beneficiary? Today, we're gonna cover that question and tell you exactly what you could expect. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel. And don't forget to hit that bell to be notified when we upload new videos twice every single week. Have you ever wondered how the living benefits and the death benefits work in a whole life insurance policy? Check out our latest YouTube video where we go over exactly how to use the living benefits and how it translates into the death benefit at the death of the insured. We'll see you there. Let's take a step back and look at how whole life insurance policies work. With a regular whole life insurance policy, the insurance company is making you two promises. The first is to pay out a death benefit when the insured dies, assuming that policy is in force. And the second is to have a cash value that's equal to the death benefit at the age of maturity, which is typically age 100 or 121. So in order to keep that second promise, these policies are actuarially designed to get better and better from a cash value perspective each and every single year, because the insurance company needs to stash more and more money away in order to meet that second promise.
So think of it like this. The insurance company is amortizing your mortality costs until age 100 or age 121. As they're putting that money away to fulfill this second promise, they're filling up that policy with equity. And that equity becomes cash value that you can borrow against.
If you're looking at a life insurance policy illustration, you'll see this under the guaranteed values. You'll see a guaranteed cash value, guaranteed by the insurance company, as well as a guaranteed death benefit. With these numbers and these values, this is the worst case scenario. You see, your obligation as the policy owner is only one. It's to pay the premiums. The insurance company is responsible for making and meeting all of the other promises within this unilateral contract. So let's transition into, how do the cash value and the death benefit relate?
And the fact of the matter is, it is all baked into the same cake. The death benefit might be $150,000. And when you die, the cash value might be $60,000. But all you're gonna get as far as a death benefit is the $150,000. Why? Because the insurance company put that money away over that time period to make sure that if you make it to age 100 or age 121, they're gonna have $150,000 in cash waiting for you.
Think of it like this. The cash value and the cash value accessibility through that policy loan provision is a living benefit. At death, you get the death benefit and the living benefit ceases. Leave us a comment down below. What questions do you have on how life insurance works? We'd be happy to answer them in upcoming videos. Another question that makes sense to ask is, what if there's a policy loan against my cash value at the time the insured dies? What happens then?
Well, basically what'll happen is, the insurance company will calculate the death benefit, $150,000, and let's assume you have a $30,000 loan against the policy at the time of your death. They subtract that $30,000 from the $150,000, and your net death benefit is $120,000. So we often get the question, why don't I get the death benefit plus the cash value? Certainly there are some financial gurus out there saying, hey, the problem with whole life is you don't get the cash value and the death benefit. Duh, no, you don't. If you have a mortgage against your house, let's say the house is worth $300,000 and you have a $200,000 mortgage against the house. If you go to sell the house, you don't get the $300,000 plus the $200,000. What happens is the buyer pays $300,000. Your net is $100,000. And so it is with life insurance. If you die with a $150,000 death benefit and $50,000 of cash, you get the $150,000 of death benefit. You don't get the $150,000 plus the cash.
If you'd like to get started with a specially designed whole life insurance policy designed for cash accumulation so that you're able to take advantage of the living benefits as well as the death benefit included in this whole life insurance policy, be sure to check out our website at tier1capital.com. Feel free to hop on our calendar with Schedule the Strategy Session button. Or if you'd like to learn more about exactly how we put this process to work for our clients, check out our free web course right on the homepage, The 4 Steps to Financial Freedom. If you like this video, be sure to check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.